Today, we're diving into 5 assets that can make you rich. Whether you're a seasoned investor or just starting to explore your financial options, this video is tailored to help you understand where and how to invest your money wisely. But first, I'd love to hear from you. What type of investments have you considered or currently hold? Drop your answers in the comments below as we get started. Investing isn't just about stashing your money away. It's about choosing the right assets that grow and secure your wealth over time. Today, we'll explore some of the most lucrative assets that can potentially transform your financial landscape. Let's get into it and start building a richer future. Number 1. Real estate investments. Moving into our first asset category, let's talk about real estate investments, a cornerstone of wealth building for countless investors. Real estate provides a unique combination of safety, steady cash flow, and significant appreciation potential, making it a favorite among those looking to build long-term wealth. Types of real estate investments. Real estate investments come in several forms. First, there's residential real estate, which involves properties like houses, apartments, and vacation rentals. These are typically leased to individuals or families, providing a regular income through rent payments. Then, we have commercial real estate. This includes office buildings, shopping centers, and industrial properties, which generally yield higher rents and longer lease terms, translating to more stable cash flow. Another interesting option is real estate investment trusts, or REITs. These are companies that own or finance income-producing real estate across a range of property sectors. REITs offer the benefit of real estate investment without the need to directly buy properties. They're also highly liquid since they're traded on major stock exchanges. Financial benefits of real estate investing. One of the key attractions of real estate investing is the potential for rental income, which can provide a steady stream of cash to cover expenses and generate profit. Moreover, property values have historically appreciated over time, allowing investors to sell their properties for a significant profit in the future. Additionally, real estate offers benefits like tax deductions on mortgage interest, property taxes, and other expenses associated with owning a property. However, successful real estate investing isn't just about picking any property. Location is paramount. The right area can mean the difference between high vacancy rates and a waiting list of potential tenants. Economic factors, such as the local job market and population growth, also influence real estate values. Understanding market conditions, such as knowing when to buy and sell, is crucial. For this, engaging with local real estate experts and conducting thorough market research are indispensable. Real estate investment can be highly lucrative, but requires careful consideration of property type, location, and economic conditions. With the right approach, real estate can be a powerful vehicle for wealth accumulation. Number 2. Stocks. Next is investing in stocks, a dynamic and potentially rewarding avenue to grow your wealth. Stocks represent ownership in a company. When you buy shares, you're essentially buying a piece of that company's future profits and growth. Understanding the stock market. The stock market allows individuals and institutions to buy and sell shares in publicly traded companies. A vibrant market reflects the economic health of a society and offers individual investors a way to participate in a company's successes or failures. When you invest in stocks, you become a partial owner of the company. This ownership comes with potential financial rewards, including dividends and capital gains. The potential for long-term growth. One of the most compelling reasons to invest in stocks is the potential for long-term growth. Historically, equities have offered more robust returns over the long term than other more conservative investments like bonds or savings accounts. This growth comes from capital gains, where the value of the stock increases over time as the company grows, and from dividends, which are payouts companies make to their shareholders out of profits. The power of compounding. Compounding is another vital aspect of stock investing. Reinvesting the dividends you receive from stocks can significantly enhance the growth of your investment portfolio over time. It's not just about the gains on your original investment, but also about the gains on those gains, a powerful way to build wealth. How to pick stocks. Selecting the right stocks is crucial. Start with fundamental analysis, which involves evaluating a company's financial statements to assess its health and potential for growth. Look for companies with strong earnings growth, solid management, and competitive advantages in their industry. Diversification is equally important. By spreading your investments across various sectors and companies, you reduce the risk of significant losses. If one investment performs poorly, others in different sectors might perform well, balancing your portfolio's overall performance. Investing in stocks requires an understanding of market dynamics and a thoughtful approach to selecting and managing your investments. With a focus on long-term growth, dividends, and diversification, stock investments can significantly increase your financial wealth. Number 3. Bonds. Let's delve into bonds, another fundamental asset class that can fortify your investment portfolio. Bonds are essentially loans that you, as the investor, give to an entity such as a corporation or government in exchange for periodic interest payments, plus the return of the bond's face value at maturity. Understanding bonds as investment vehicles. When you purchase a bond, you are lending money to the issuer, who in return promises to pay back the face value on a specific date, known as the maturity date. Until that date, the issuer also pays you interest, typically at a fixed rate. This makes bonds a relatively stable and predictable investment compared to the more volatile stock market. Types of bonds and their characteristics. Government bonds. These are issued by national governments and are often considered the safest bond investments because they carry the backing of the government itself. They usually offer lower yields due to their lower risk. Municipal bonds, issued by states, cities, or other local government entities. Municipal bonds often provide tax-free interest income, making them particularly attractive to investors in higher tax brackets. Corporate bonds. These bonds are issued by companies. They tend to offer higher interest rates than government and municipal bonds because they come with a higher risk of default. The impact of interest rates and risk profiles. The relationship between bonds, interest rates, and risk profiles is pivotal to understanding bond investments. When interest rates rise, bond prices typically fall, and vice versa. This inverse relationship is crucial because it affects the market value of bonds, especially if you plan to sell them before they mature. Risk profiles vary significantly across different types of bonds. While government bonds are generally low risk, corporate bonds can range from relatively safe, investment grade, to quite risky, high yield or junk bonds. Assessing the creditworthiness of the issuer is critical in evaluating the risk associated with a bond. Bonds can provide a stable income stream and serve as a good diversifier for your investment portfolio. Understanding the types of bonds and how interest rates affect them will help you make informed decisions, balancing the trade-off between risk and return in your overall investment strategy. Number 4. Mutual funds and ETFs. Let's explore mutual funds and exchange-traded funds, ETFs, two types of investment vehicles that pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. How mutual funds and ETFs work. A mutual fund is managed by professional fund managers who allocate the fund's investments in an attempt to produce capital gains or income for the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment objectives stated in its prospectus. ETFs are similar to mutual funds in that they also represent a collection of investments that can range from stocks and bonds to commodities and currencies. However, unlike mutual funds, ETFs are traded on stock exchanges like individual stocks throughout the trading day at market-determined prices. Active versus passive fund management. The management style is a fundamental difference between mutual funds and ETFs. Mutual funds can be actively managed, where fund managers make decisions about how to allocate assets in the fund, trying to outperform the market. Alternatively, they can be passively managed, following a specific index with no intention of outperforming it, but rather of matching its returns. In contrast, most ETFs are passively managed and track a particular index, such as the S&P 500. They tend to have lower expense ratios and fewer broker commissions than actively managed mutual funds because they don't require the same level of active decision-making and can be bought or sold like a stock without needing a fund manager's intervention. Advantages of mutual funds and ETFs. One of the primary advantages of both mutual funds and ETFs is diversification. By investing in a fund, you gain exposure to a broad array of securities within one investment, which can reduce your portfolio risk compared to investing in individual securities. Moreover, ETFs offer the flexibility of trading throughout the day, which can be beneficial for tactical asset allocation and for taking advantage of market movements. On the other hand, mutual funds provide the advantage of professional management, which can be a boon for investors who prefer a hands-off approach or lack the time to manage their own investments. Mutual funds and ETFs provide opportunities for diversification and professional management, making them essential tools for both novice and experienced investors looking to enhance their portfolios and manage risk effectively. Number 5. Business ownership. Business ownership, an avenue many pursue for potential high returns, but it requires significant engagement and risk assessment. Financial implications of starting or investing in a business. Investing in or starting a business can be one of the most rewarding, albeit risky, investments. Financially, it involves not just the initial capital outlay to launch or buy into a business, but also ongoing expenses such as payroll, supplies, and marketing. However, the potential for substantial income from a successful business can far outweigh the initial and operational costs. Risk assessment and engagement. The level of risk in business ownership varies widely depending on the industry, market demand, and management. A thorough risk assessment includes analyzing market conditions, competitor analysis, and financial forecasting. Moreover, the success of a business often hinges on the owner's commitment. Unlike passive investments, business ownership requires active management and a high level of involvement to navigate daily operations and strategic decisions. Let's Meet Spanx by Sarah Blakely. Started with her savings of $5,000, Sarah Blakely's idea of a better undergarment turned into a billion-dollar brand without any external funding or advertising. Steve Jobs and Steve Wozniak started Apple in a garage, with a small investment primarily funded by selling personal items like Wozniak's scientific calculator and Jobs' van. Today, Apple is a global powerhouse in technology. Michael Dell began Dell Computers in his college dorm room with less than $1,000 in startup capital. Focusing on direct sales of PCs at a lower cost than traditional retailers, Dell became one of the biggest PC manufacturers worldwide. These examples show that with innovation, dedication, and smart management, starting small doesn't prevent scaling big. Each of these businesses started with limited funds, but grew through strategic decisions and strong market understanding. While business ownership carries significant risks and demands a high level of involvement, it also offers the potential for substantial rewards and personal satisfaction. For those prepared to dedicate the necessary time and resources, it represents a profound opportunity to build wealth. Remember, thorough research and understanding your risk tolerance are crucial as you decide which investments suit your financial goals. If you found this guide helpful, please hit that like button, subscribe for more financial insights, and share your thoughts in the comments below.